When a man studies the market long enough, he begins to see that the tape has a rhythm. The crowd may chatter, the headlines may distract, but the chart it speaks in silence. And what it whispers most often, if you care enough to listen, is patience. The market does not always trend. In fact, most of the time it sits still, pacing back and forth like a caged animal, testing the bars. That's what traders call a consolidation zone. Now, I know you've seen it, the price bouncing between a ceiling and a floor, neither side willing to surrender. And many beginners, when they see that, they complain. They want movement, excitement, fireworks. But the man who's learned the lessons of survival in speculation knows better. He knows that the real move, the profitable one, begins with the quiet. Think back to the previous video on hawk eye and trading. We spoke about sharpening your vision, about training your eyes to catch what others miss. That skill is your weapon when you face a consolidation. Because to the untrained, it looks like a waste of time. But to you, if you learn correctly, it's the market preparing the feast. And the feast is for those who can wait without growing restless. Tell me, haven't you ever jumped too soon? Only to watch the market break out after you've already spent your bullets. Now let me say it plainly, trading a consolidation zone is not gambling. It is a study in discipline. You must first identify the box, the high, and the low where price keeps returning. The more touches, the stronger the walls. If the market respects those boundaries 5, 6, 7 times, you can be certain the crowd sees it too. And the crowd's recognition is your confirmation. But here's the rub: knowing the box is not the same as trading the box. Do you understand the difference? One is observation, the other is execution. Execution begins with preparation. The consolidation is like a spring coiling. Each bounce builds pressure. Your task is not to predict the exact moment it will snap, but to be ready when it does. You draw your lines, you watch your volume, you take note of the wider trend. Is this box forming after a long rise? Then perhaps it is a pause before continuation. Or does it follow a steep fall? Then maybe it's just catching its breath before dropping further. Context is king. The box alone is not enough. Without context, you're blind. Haven't you ever mistaken a pause for reversal, only to watch the market prove you wrong? The patient trader waits for price to declare itself. That declaration comes when the walls break. The breakout. Now here's where most lose their money. They chase too early. They see a single candle poke its head above the line, and they rush in. The market, sly as it is, often punishes them with a false breakout. That's the test. The market asks, are you disciplined, or are you just eager? Your answer decides whether you survive. I always wait for confirmation. Not a whisper, but a shout. Volume rising, price holding beyond the line. No quick retreat. That's when the move begins. But don't fool yourself into thinking this is a free ride. Trading breakouts is about timing and money management. Suppose you enter on confirmation. Do you know where your stop belongs? It belongs just inside the box. Because if price falls back into that zone, your trade idea has failed. You exit without debate. A man who refuses to take a small loss will one day be forced to take a large one. Which would you rather have? Now, as the move begins, greed tempts you. It whispers, hold it forever. This is the big one. But wisdom says otherwise. A move that begins out of consolidation will run, yes, but it will also rest. So you must have profit targets. Maybe you aim for twice your risk. Maybe you trail your stop as the trend unfolds. What matters is that you protect your winnings. Because markets are merciless to those who get careless. Have you ever seen a paper profit vanish because you refuse to lock it in? If you have, you already know this truth. Let's not forget, consolidation zones also offer range trades, not just breakouts. While price is trapped, some traders buy the floor and sell the ceiling. It works, but it's not my style. It demands sharper reflexes, smaller profits, and more attention. The reward is consistency. The risk is death by 1,000 cuts. Do you have the temperament for that? If not, don't force it. The worst mistake is copying a method that doesn't fit your nature. In speculation, as in life, you must know yourself first. The real wealth, my friend, is not made in catching every wiggle. It's made in waiting for the rare, the obvious, the decisive. The consolidation zone is where the market builds energy. The breakout is where that energy explodes. You want to be positioned for the explosion, not gambling on the noise. That's why I keep saying discipline, discipline, discipline. Without it, you're feeding the bucket shops. With it, you're on the path to survival. And survival, in this game, is the only road to profit. Do you recall how, in the Hawkeye discussion, we spoke about scanning the chart as a hunter scans the field? The same principle applies here. The hunter doesn't fire at every rustle in the grass. He waits for the real target. So too must you. The consolidation is the grass moving, the breakout that's the deer stepping into view. If you fire too soon, you waste your chance. Another thing, don't let boredom lure you into mischief. When price chops sideways for days or weeks, your patience will itch. You'll tell yourself, let me just try a little trade here, a small bet there. That's the path to ruin. I learned it the hard way, as every trader does. The market is not a slot machine you pull because you're restless. It is a field of battle, and every bullet must be rationed. Ask yourself, would a general waste his troops on a skirmish that gains him nothing? Then why would you? You must also pay attention to volume. When consolidation forms, volume often dries up. The crowd loses interest. That's normal. But when volume returns with force, that's your signal. Volume is the breath of the market. It tells you when the crowd has awakened. Price without volume is like a voice without conviction. It may say the words, but it won't carry. Do you listen for that? Or are you deaf to the undertones? And let's speak of mindset. Because trading zones is not just a matter of charts, it's a matter of psychology. A consolidation zone tests your patience, your discipline, your ability to do nothing. Most men fail not in their analysis, but in their restraint. They can't stand still. They mistake activity for progress. But in speculation, doing nothing is often the wisest move. It's a strange business, isn't it? You profit by sitting tight, by waiting, by refusing to act until the odds are right. Can you handle that? Or will you sabotage yourself? Think also of capital. The professional trader treats his capital as his ammunition. He does not waste it firing at shadows. He saves it for the moment when the odds tilt in his favor. A breakout from a consolidation is such a moment. If the setup is strong, the context favorable, and the confirmation clear, that's when you risk your powder. Until then, you sit with folded arms. Some may call it laziness. I call it wisdom. The secret is not to trade often, but to trade well. A few strong moves in a year can make your fortune if you ride them correctly. Meanwhile, 100 small, careless trades will bleed you dry. Consolidation zones offer you the chance to pick your spots. They tell you something is coming. Be ready, and readiness in speculation is everything. Haven't you ever missed a move simply because you weren't prepared? You saw it, you understood it, but you weren't ready to act. That won't do. The market doesn't care about your feelings. It doesn't care if you're bored or hungry or desperate. It only rewards preparation and discipline. A man who respects that truth will survive. A man who doesn't will be swept away. Which man will you be? When a trader looks at a chart for the first time, the eyes usually chase after the obvious sharp rises, sudden crashes, dramatic spikes that seem to tell the story of riches made or lost in a matter of hours. But the seasoned operator learns, through many wounds and scars, that those bright movements often hide the real lesson. The real work, the true preparation, begins with the stillness. Price does not run forever. It pauses, it gathers its breath, it hesitates in a narrow band of action. And if you study carefully, you will notice something fascinating. Price does not hesitate randomly. It returns again and again to certain levels, almost as though it were bound by invisible walls. These levels support beneath and resistance above become the edges of a box. Inside that box is the consolidation zone. Identifying those boundaries is not a trick, nor is it an art for dreamers. It is a skill forged through careful observation, tape reading, and respect for repetition. Because in the market, repetition is the closest thing you will ever find to a law. When I speak of boundaries, I do not mean the kind drawn with ruler-straight precision, as if the market were a carpenter's table. The market is human nature, and human nature is never perfectly clean. You will see wicks piercing above resistance, dips clawing beneath support, only to snap back quickly. That is noise, the market's way of shaking out the weak hands. But the more often price returns to roughly the same levels, the stronger those levels become. Every touch is another vote of confidence from the crowd, another reminder that buyers and sellers agree, for now, on those limits. Your job is to notice it, to mark it, to recognize when a zone is no longer just random fluctuation, but a meaningful cage. Do you ever find yourself ignoring those small bounces, thinking they mean nothing, until suddenly you realize the market has been respecting the same levels for days or weeks? That's the blindness you must cure. Identifying the boundaries begins with training your eye to see clusters. Look at where the price turns most often. A single reversal means little, but 3 or 4 reversals, all within a tight range, are a clue. And as the number of touches grows, so does the strength of that boundary. If the market has honored a level 5 or 6 times, it is no longer coincidence. It is recognition. Recognition from the crowd is the raw material of speculation. Because what moves price is not your opinion nor mine, but the collective behavior of all participants. When they all see the same ceiling, when they all trust the same floor, the zone hardens into reality. The crowd makes it real. Support, the lower boundary, is the place where demand overpowers supply. Each time price dips there, buyers step in, unwilling to let it fall further. Resistance, the upper boundary, is where supply overpowers demand. Sellers swarm in, convinced the price is too high. Think of it as a tug of war. Neither side has enough strength to win outright, so they hold each other in stalemate. The rope tightens, loosens, but the center hardly shifts. That is consolidation. And while the impatient see stagnation, the observant see potential. Because the longer the stalemate, the more violent the resolution once one side finally breaks. Do not underestimate the importance of clarity. The boundaries you identify must be visible not only to you but to the masses. If you require complicated indicators, exotic formulas, or obscure calculations to justify them, then they are not strong boundaries. Strong boundaries are obvious, so obvious that the crowd cannot miss them. The crowd's recognition is what gives them power. A line on your chart that nobody else sees has no meaning. The floor and ceiling that everyone respects, that is where battles are fought. So ask yourself, when you mark a line, would the average trader see this too? If the answer is yes, then you are on solid ground. Once you have drawn the zone, you must respect it. Too many traders draw their lines, nod their heads, and then ignore them in the heat of action. They convince themselves, this time is different. The price will surely break through. But the tape shows otherwise. Until the boundary is broken, it is law. That is the rule you must hammer into your skull. Do you ever catch yourself making excuses for the market, trying to anticipate rather than observe? That is the gambler's disease. The professional deals with what is, not what he wishes. Remember also that the strength of the boundary is not measured by time alone, but by the energy stored within it. Each bounce inside the zone adds pressure. Traders on both sides grow restless, piling in with stops and pending orders just beyond the edges. The longer the price oscillates within, the greater the buildup. When the breakout comes, the release can be sudden and explosive. But here lies the trap. The market, knowing the crowd is watching, often feints with false moves. A candle may pierce resistance, luring eager buyers, only to snap back cruelly into the box. The same trick works in reverse with support. That is why identifying the boundary is only step one. You must learn to respect it until the market proves, without doubt, that it has been conquered. And the proof comes not from a single poke, but from sustained action beyond the line. Think about the psychology. Every time price hits resistance and retreats, sellers grow confident. Every time it hits support and rebounds, buyers grow confident. They build positions. They place stops just beyond the lines. When finally the boundary is broken with conviction, all those stops ignite like gunpowder, fueling the very move they feared. That is why clear boundaries matter. They are not just lines on a chart. They are the emotional fault lines of the market. To identify them is to understand where the next earthquake may strike. Now let's speak of mistakes. Many beginners make the error of drawing zones too loosely, marking every minor twitch. They mistake noise for structure. But the true consolidation zone is not built on chance. It is built on repetition, on rhythm, on clear evidence that the market respects those levels. If you cannot look at it and immediately say, yes, this is the box, then it is not strong enough. Clarity is everything. Have you ever seen a chart cluttered with so many lines that the trader could not tell one from the other? That is confusion, and confusion is fatal. You must also be wary of fitting the zone to your bias. Suppose you are bullish. You may draw support tighter than it really is, convincing yourself the price cannot fall further. That is not analysis. That is hope in disguise. Hope has no place in speculation. The boundary exists whether you like it or not. Your job is to recognize it honestly. If you can't, the market will punish you until you learn. Another key is time frame. Boundaries look different on different scales. What seems like noise on a daily chart may be a clear consolidation on the hourly. What looks like a tight range on the weekly may be full of wild swings on the intraday. So you must decide what is your battlefield. If you are trading short term, you mark the zones on the shorter chart. If long term, you step back and let the larger picture guide you. But never confuse one with the other. A short-term boundary may be irrelevant to a long-term trend, and vice versa. Context, always context. Do you sometimes forget to zoom out, chasing the small picture while missing the larger war? That's the trap of tunnel vision. The discipline of identifying consolidation boundaries is not glamorous. It doesn't make your heart race. It feels slow, almost tedious. But it is the foundation of breakout trading, and breakout trading is where fortunes are made. You cannot ride a powerful move without first knowing where the coil is wound. You cannot anticipate the release without first marking the cage. And every cage is built by the same process. Repeated respect for clear levels, recognized by the crowd, confirmed by the tape. It sounds simple, doesn't it? And it is. But simple does not mean easy. The difficulty lies in execution, in training your eyes, in forcing your mind to wait for the obvious instead of chasing the uncertain. The market will test you. It will tempt you to act when the boundaries are not clear, when the box is half formed, when the crowd is still undecided. It will whisper, take a chance, perhaps this is the start. But speculation is not about chances. It is about certainties, as close as you can come to them. And the nearest thing to certainty is a well-defined consolidation zone, tested again and again, visible to all, ready to burst. Until you learn to see that you will always be chasing shadows. And chasing shadows, my friend, is no way to survive in this game. A market move never begins out of nothing. It does not rise to the heavens without preparation, nor does it sink into the abyss without warning. Every large trend you have ever watched began with a period of silence, a stretch of time when the price seemed to move without conviction, trapped inside narrow boundaries. That period is not meaningless. It is the groundwork, the energy gathering itself before expression. Think of it as a spring being wound tighter and tighter. Each tick inside the range is pressure stored, and when the lock is finally released, the stored energy bursts forth in a decisive direction. That is why a consolidation must never be dismissed. It is not the absence of opportunity, it is opportunity incubating, waiting for the moment to emerge. A trader who fails to recognize this misinterprets the game entirely. He looks at the sideways action, shrugs, and says, nothing is happening here, but something is happening. The market is choosing sides, buyers and sellers matching strength, neither able to claim victory yet. The battlefield looks quiet, but beneath the surface is a hidden storm. Imagine a dam holding back a river. On the surface the water is still, almost peaceful, but the weight behind it builds with every passing moment. When that dam breaks, you do not get a trickle, you get a flood. Have you ever seen a chart that moved sideways for weeks, boring everyone into sleep, only to explode with a trend that ran farther than anyone thought possible? That explosion was born from the pressure built in the consolidation. Now here is where most traders falter. They do not understand that waiting is part of the work. They want action every day, every hour, as though the market were a machine designed for their entertainment. They treat consolidation as wasted time. But a professional knows better. The stillness is part of the process. You cannot have movement without stillness first. To despise consolidation is to despise the very condition that makes big moves possible. Can you see the irony? The amateur avoids it, the professional hunts for it. Every time price tests the same support or resistance, more participants take note. They see the ceiling. They see the floor. They place their bets. Stops cluster on both sides. Orders pile up just beyond the walls. Energy is coiling. It is not visible in the same way a trend is visible, but it is real. And when at last the market tips its hand, the release is swift. The trapped orders ignite, fueling the breakout. Those who saw the coil forming are prepared. Those who ignored it are left chasing, too late. How many times have you watched a breakout unfold and thought, if only I had seen it earlier? The earlier signal was there, in the consolidation, in the energy building. Let us speak of human nature, because the consolidation is not merely a chart pattern, it is a mirror of psychology. During that sideways action, traders grow impatient. They push and pull at the boundaries. Some try to force trades inside the box, scalping small gains, risking whipsaws. Others give up entirely, abandoning the chart for greener pastures. What remains is a market with dwindling participation, volume drying up, volatility narrowing. And that is when the coil is most dangerous, when nobody expects it anymore. When boredom has numbed the crowd, the market strikes. It breaks free, volume surges, volatility returns with a vengeance. If you understand this, you will see consolidation not as a dead zone, but as a trap for the careless and a gift for the patient. Energy in the market is not unlike energy in nature. Think of a volcano. The mountain may look calm for years, even decades. Tourists climb it, build houses nearby, mock its silence. But beneath the surface, pressure mounts. One day the earth cracks, and the eruption destroys everything in its path. The market's consolidation is the same principle, though in smaller scale and shorter time. The silence is the warning. The pressure is the preparation. The eruption is the breakout. Would you mock the stillness of the mountain, or would you respect it? If you respect it, you can position yourself far from danger or directly in the path of profit. The crucial part of trading consolidations is not in predicting the direction of the breakout, but in recognizing that a breakout is inevitable. Too many traders waste their effort trying to forecast up or down before the market gives its signal. That is arrogance. The wise man prepares for either outcome. He marks his boundaries, he watches volume, he sharpens his attention. When the breakout comes, he does not argue with it, he follows it. The direction is less important than the recognition of the energy release. The trend will tell you where to go once it starts. But the opportunity belongs to the one who respected the build-up. Another layer of truth is this: the longer the consolidation, the stronger the move that follows. A short pause may lead to a brief continuation, but a long drawn-out box, tested again and again, can unleash a move that defines the market for months. This is because the longer the coil, the more orders gather, the more tension accumulates, the more psychology intensifies. When that coil finally breaks, the flood of activity is greater, the participation broader, the conviction deeper. Can you recall the times when the market broke from a year-long base and ran for miles? Those are the trades that make careers, and they are born in the quietest of periods. Think also of the mindset required. To wait through consolidation demands patience that most men do not possess. They itch to trade, to feel the rush of action. But trading is not about thrills. It is about money, survival, and discipline. The man who cannot sit still when nothing is happening will never be around to enjoy the move when it finally comes. This is the paradox of speculation. The less you do during the build-up, the more you make during the release. Do you have the stomach to sit, to wait, to watch without acting? That is the test of character. The energy inside a consolidation is not only technical but emotional. Bulls and bears fight in silence. Each side believes the other will break first. Confidence grows, stubbornness deepens, positions build, and then, like a rope snapping, one side collapses. The defeated rush to cover, fueling the move of the victors. That is the hidden drama you are watching when price moves sideways. It is not inactivity, it is conflict, muted but unrelenting. To recognize this is to see beyond the candles, into the psychology that drives them. So when you look at a chart and see price locked in a narrow zone, Do not curse the market for boring you. Thank it. Thank it for revealing where the energy is stored, where the crowd is waiting, where the next great opportunity may come. The coil is the prelude. The build-up is the promise. The explosion is the reward. Without consolidation, there is no power behind the trend. With consolidation, the trend gains the force of all that stored impatience, all that hidden pressure, all that silent preparation. A trader who understands this does not fear the quiet. He respects it, he prepares for it, and he profits when the silence breaks. When you study a chart long enough, you begin to notice that price alone does not tell the full story. A candle can climb or fall, it can stretch or shrink, but without its companion it remains incomplete. That companion is volume. Volume is the heartbeat of the market, the record of participation, the weight behind the move. A price move without volume is like a man shouting in an empty room. He may raise his voice, but no one is listening. A price move with volume, however, is a crowd roaring in unison, a force that cannot be ignored. That is why, when you face a consolidation zone, you must pay close attention, not only to the walls that bind the price, but to the breathing of the market inside those walls. During a consolidation, volume usually begins to contract. It shrinks gradually as the crowd loses interest, as traders grow tired of the back and forth. The excitement that fueled the last trend has burned out, and now the market rests. Buyers hesitate to buy higher, sellers hesitate to sell lower, and so both sides retreat into cautious observation. The tape reflects this hesitation with thinning volume. That contraction is not a sign of weakness, it is a sign of energy being bottled up. Like a fire smoldering beneath the ash, the potential is still there, waiting for oxygen. Do you see the subtlety? The crowd thinks nothing is happening, but in truth, the stage is being set. As the zone matures, the volume tells you how serious the stalemate has become. Each rally to resistance meets less enthusiasm. Each dip to support meets fewer sellers. The crowd grows wary of the struggle. Liquidity dries. The box becomes quieter and tighter. That quietness is dangerous. It lulls traders into carelessness. They stop paying attention. And that is exactly when the market likes to make its real move. Have you ever noticed that the biggest breakouts often occur after the longest, dullest stretches of inactivity? That dullness was marked by low volume, the silence before the storm. Then comes the moment of change. When a breakout is real, it does not creep out of the box timidly. It bursts forth with conviction, and conviction is measured in volume. A true breakout is accompanied by a surge in participation, a flood of orders rushing in as the crowd wakes up. The tape swells, the bars grow tall, and the quiet box is left behind. That surge of volume is the confirmation you wait for. Without it, the move is suspect, a mere poke at the boundary. With it, the move has muscle, it has teeth, it has the support of the market behind it. False breakouts reveal themselves in the opposite way. Price pokes above resistance or slips below support, but volume does not join the move. The crowd remains unconvinced, participation stays thin, and the market quickly snaps back into the box. These are the traps that catch eager traders who rush in too soon. They see the line broken, they think the war is over, but the soldiers never showed up. That is why volume is your filter. It tells you whether the breakout is a true charge or just a feint. Have you ever been caught buying a breakout that collapsed instantly? If you had looked at volume, you would have seen the warning. It is not enough, however, to glance at a single bar of volume. You must compare. You must ask, is this breakout supported by more activity than the consolidation before it? Is the volume rising above the average of recent sessions? A breakout without an increase in volume is like a general charging the enemy with fewer troops than he had in training. It cannot last. But when the breakout comes with a swell of volume far beyond the quiet of the box, that is the general leading his army at full strength. That is the kind of move you can trust. There is another subtlety. Sometimes inside the consolidation, you may see sudden spikes of volume without a breakout. These are tests. The market is probing the boundaries, seeing if the other side is ready. A rush of volume pushes the price to resistance, but sellers push it back. Or volume surges on a dip to support, but buyers defend the line. These failed pushes tell you something important: the walls are strong. but the pressure is rising. Each failed attack adds to the tension, and when finally one side collapses, the stored energy is released with even greater violence. Do you see how volume gives you insight not only into the breakout, but into the struggle within the box itself? Volume is also tied to psychology. When traders are uncertain, they step back and volume contracts. When conviction returns, they step in and volume expands. Thus, volume is the reflection of collective confidence. The stronger the expansion, the stronger the conviction, and the longer the move can carry. That is why professional traders say, volume precedes price. It is often true that before the breakout candle appears, you will already see volume beginning to rise, a subtle clue that the crowd is stirring. If you are attentive, you can spot this clue and prepare before the masses notice. Have you ever wondered how some traders seem to enter just before the big move? Often, it is because they read the volume while everyone else stared only at the candles. It is also important to recognize that not all markets carry volume in the same way. In stocks, volume is tied directly to participation, to the buying and selling of shares. In futures or forex, the story is more nuanced. But the principle remains: measure the activity, watch for contraction during consolidation and expansion during breakout. Even when you cannot trust absolute numbers, the relative change tells the story. The ebb and flow of volume is universal because it reflects human behavior, and human behavior is the same across instruments. Consider also the role of liquidity providers and large players. During consolidation, the big money often stays quiet, accumulating positions slowly, leaving little footprint. That is why volume contracts. But when the time comes to move, they reveal themselves in a burst of activity. The breakout bar shows their hand. By watching volume, you are watching for their presence. You cannot see them directly, but you can see their shadow in the tape. And it is their presence, not the chatter of small traders, that fuels the trend. One of the hardest lessons for any trader is to accept that price action without volume is not trustworthy. You may see a clean technical setup, a beautiful breakout on the chart, but if the tape does not swell, you must doubt it. This discipline is what separates the professional from the amateur. The amateur acts on sight alone. The professional waits for confirmation, and confirmation is spelled in volume. Do you have the patience to demand that proof, or will you chase every breakout that flickers across your screen? Remember also that volume tells you when to step aside. Sometimes a breakout comes, but the volume is average, unimpressive. That is not your trade. The market is whispering, not shouting. A professional ignores whispers. He waits for the roar. This refusal to act on weak signals is what preserves capital, and capital preserved is capital ready for the next true opportunity. Many fortunes have been lost not from bad analysis, but from impatience with volume. The study of volume inside consolidation zones is not complicated, but it requires attention and honesty. It requires you to accept boredom, to accept waiting, to accept that silence is part of the process. It requires you to measure, compare, and interpret rather than chase. And when the moment comes, when the volume explodes and the price leaves the box, it rewards you with clarity. That clarity is rare in the markets. It is the difference between guessing and knowing, and if you want to trade consolidation successfully, you must learn to let volume be your guide, to trust it more than your impulses, to recognize in its ebb and flow the hidden energy that drives every breakout you will ever see. A chart without context is like a sentence without a story. You may see words, you may even understand the letters, but you miss the meaning if you don't know what came before and what follows after. In trading, context is everything. A consolidation zone by itself is simply a sideways stretch of price. It could mean continuation, it could mean reversal, it could mean exhaustion. Without the background, you are like a man stepping into a play halfway through, trying to guess who is the hero and who is the villain. You cannot know what a box means unless you know where it sits in the broader trend. Imagine this price has been climbing steadily for weeks. Buyers are in control, demand outweighs supply, and optimism runs high. Then the climb pauses and price begins to move sideways. To the untrained eye, it is just another consolidation. But to the trader who respects context, It is a possible flag of continuation, a rest before the next leg higher. The market is not reversing, it is gathering strength. That box carries a very different meaning than if it appeared after a long fall. Do you see why the background matters? Now picture the opposite. Price has collapsed for months. Fear dominates, sellers dictate every move. Suddenly, the slide halts and price begins to move sideways in a tight range. To the casual trader, it looks the same as the earlier box. But in truth, it may be a base forming, a sign that the selling pressure is exhausted and buyers are quietly entering. The same shape on the chart consolidation carries an entirely different implication depending on what came before. Without that knowledge, you are blind. Haven't you ever taken a trade inside a zone only to realize later that you misread the bigger story? That is why the first question you must ask yourself when studying a consolidation is not where are the boundaries, but what is the trend leading into this? The direction of the move into the zone often dictates the probability of the move out of it. A strong uptrend, followed by a pause, more often resolves higher. A steep downtrend followed by a stall more often resolves lower. This is not a guarantee, nothing in speculation ever is, but it is a weight on the scale, a bias that tilts the odds in your favor. And in this business, odds are everything. But context does not stop with the immediate trend. You must also consider the larger time frame. A consolidation that looks bullish on the daily chart may simply be a pause within a massive downtrend on the weekly, or a sideways box on the hourly may be nothing more than noise inside a broader daily rally. The professional zooms out. He checks the higher frame to see the bigger war before committing his troops to the skirmish on the lower. Do you ever catch yourself fixated on a 5-minute chart, forgetting that the daily candle may be telling a completely different story? That is the mistake of tunnel vision, and it costs dearly. Think also about levels of significance. A consolidation forming just beneath a major resistance, one tested for months or years, carries different weight than one forming in the middle of open air. If price pauses just below an all-time high, you know the breakout will attract attention. Every participant is watching, waiting for confirmation. The energy is immense, but if the same box forms in the middle of a trend with no major levels nearby, the interest may be less, the breakout weaker. Context is not only about trend, but also about location. Where the zone sits on the map of the market changes its meaning. Volume, too, ties into context. A consolidation with shrinking volume after a rally often means a healthy pause, but a consolidation with spiking volume after a long run may mean distribution, big players unloading into eager buyers before a reversal. The background changes the interpretation of the same signal. Without context, you cannot tell whether the crowd is preparing to continue or preparing to abandon the move. And if you cannot tell, you are gambling, not trading. Market cycles themselves are context. Accumulation, uptrend, distribution, downtrend, these phases repeat endlessly. Where does your consolidation sit within that cycle? Is it a base of accumulation at the bottom or a topping range at the peak? The form may look the same, but the outcome is entirely different. Understanding this requires more than drawing boxes. It requires reading the market as a living organism, breathing in cycles, moving through phases. That is what separates the operator from the amateur. Psychology is part of context as well. After a long rally, the crowd grows complacent, convinced the market can only rise. A sideways box in that condition may be the calm before the final thrust or the trap before a collapse. After a long decline, the crowd is fearful, convinced the market can only fall. A sideways box, there may be the exhaustion of selling, a prelude to recovery. The shape of the chart is the same, but the mindset of participants is opposite. To understand the zone, you must understand the mood that surrounds it. Have you noticed how markets often turn when the crowd is most certain of one direction? That certainty is part of the context. Consider also external conditions. News, earnings, economic cycles, these frame the backdrop against which a consolidation plays out. A sideways zone during earnings season may resolve violently once the report is out. A sideways zone during calm periods may drift longer before moving. Again, the form alone tells little. The frame tells the story. A soldier does not fight without knowing the terrain. A trader should not speculate without knowing the environment. Now, some may argue that price alone is enough, that context is unnecessary, but those are the same traders who chase every breakout and get burned when it reverses. They see only the box, not the story behind it. The truth is simple: price action without context is a fragment, and fragments mislead. Full understanding comes when you marry the micro with the macro, the immediate with the background, the pattern with the narrative. That is how you tilt the scales in your favor. So when you sit at your desk and draw the boundaries of a consolidation, remember to step back. Ask, what was the market doing before this? Where is this in the larger cycle? What mood does the crowd hold? What levels surround this box? What time frame am I trading, and how does it align with the bigger picture? These questions are your compass. They guide you through the fog. Without them, you are lost. With them, you can see not just the shape of the market, but its intention, its direction, its likely outcome. And that is why context matters more than the pattern itself. The box is the same, but the meaning shifts depending on the story. A wise trader reads the story, not just the sentence. He waits until the context aligns with the pattern before he risks his capital. He respects that a consolidation is never isolated, but always part of a larger tale unfolding on the chart. Only by reading the tale can you hope to trade the zone with skill, to distinguish between a pause before continuation and a base before reversal, to separate the traps from the opportunities. A breakout is one of the most tempting sights in all of speculation. The price pushes against the edge of a consolidation. It looks ready to escape, and the trader's heart begins to race. He sees a candle thrust beyond resistance or slip beneath support, and he feels the urge to act at once. But this is where the majority lose their capital, not because the idea is wrong, but because the timing is reckless. The truth is that a breakout should never be trusted on the first poke. The market, sly as it is, loves to lure the impatient. It feints, it pretends, it shows its hand only to snatch it back. That is the false breakout, and it is the graveyard of eager money. The first mistake men make is believing that price alone defines a breakout. They see one candle close above the boundary, and they think the war is won. But the boundary is not merely a line, it is a battlefield where buyers and sellers clash. One candle does not end the fight. Often, the very first push beyond the line is nothing more than a probe, a test to see how many weak hands can be shaken and how many stops can be harvested. Have you noticed how often price leaps just beyond resistance, only to collapse back into the box? That is not chance, it is design. The market feeds on impatience. To avoid being its victim, you must demand confirmation. Confirmation is not a luxury, it is a necessity. It is the proof that the breakout is not a mere trick, but the start of a genuine move. And what is confirmation? It is price holding beyond the boundary, not for seconds, not for a single bar, but with conviction. It is volume swelling as the crowd joins in, not shrinking as the move withers. It is the tape telling you that the battle has been decided and the losers are in retreat. Without that, you are gambling on a guess. Patience is the rarest virtue in trading. Everyone wants to be first, to boast that they caught the move at its very birth. But being first often means being wrong. The professional does not care about the first tick. He cares about the sustained move. He waits for the market to prove itself. If the breakout is real, it will not vanish in an instant. It will give you time to enter with confidence. The amateur fears missing out, the professional fears being wrong. Which fear guides your hand? There is a simple rule I have kept close: never trust the initial breakout. Always wait for the retest or the hold. If resistance is broken, let the price stay above it. Let it test the old ceiling as a new floor. Let it prove that the sellers have surrendered. If support is broken, let the price stay beneath it. Let it test the old floor as a new ceiling. Let it prove that buyers are defeated. This retest may not always come in a perfect textbook form, but the principle remains. The breakout must demonstrate strength, not merely flash it for a moment. Another form of confirmation comes from context. If the breakout aligns with the broader trend, it has higher odds of success. If it moves against the larger tide, be cautious. A breakout that runs with the river is more likely to carry you far. A breakout against the river may exhaust itself quickly. Have you ever tried to row upstream? That is what it feels like when you buy a breakout against the dominant trend. It may work, briefly, but the effort is immense and the risk high. Volume is the second key. A breakout without volume is like a soldier charging into battle alone. He may take a few steps forward, but without his army behind him, he will be cut down. The crowd must participate. Their orders fuel the move, their stops ignite the fire, their conviction carries the price away from the zone. When volume swells, you know the market has chosen a side. When it does not, you know the move is fragile. This is why you must always check the heartbeat of the market before committing. False breakouts serve a purpose, and that purpose is to punish greed. They flush out the premature, they trigger stops, they shake confidence. But for the patient observer, they are gifts. Because once the false breakout collapses, the true direction often reveals itself with clarity. Sellers who defended resistance may exhaust themselves, paving the way for the next breakout to succeed. Buyers who rushed in too soon may become fuel for the next leg down. The trap of one group becomes the profit of another. If you can resist being trapped, you can use the traps to your advantage. There is also the matter of time. A genuine breakout does not always explode immediately. Sometimes it crawls out of the box and inches forward, testing, consolidating again before truly running. This is another reason to wait. If the move is real, it will give you multiple chances to join. If it is fake, it will snap back quickly, sparing you a loss if you stayed patient. Do you see the wisdom? The market gives clues, but only to those who resist the urge to jump at shadows. The professional mindset treats every breakout as suspect until proven otherwise. He is not lured by the glamour of the first candle. He sits with folded arms, watching for proof. Only when the proof arrives does he move. And when he does, he moves with conviction, because now the odds are in his favor. He trades less often, but he trades better. That is the essence of survival in speculation. Think of the countless traders who chase every breakout they see, scattering their capital across false starts. They lose a little here, a little there, and when the real breakout finally comes, they no longer have the strength to ride it. Meanwhile, the disciplined trader, who ignored the false moves, has preserved his ammunition. He strikes only when the evidence is clear, and he reaps the reward. The difference is not luck, but patience. Every consolidation zone hides this test. The market is asking, are you disciplined enough to wait, or will you jump at the first invitation? Most will jump. Few will wait. That is why most lose and few win. It is not the pattern that makes the profit, but the behavior of the trader in response to it. The breakout is only the beginning. The confirmation is the key, and the willingness to demand that confirmation again and again is what separates the professional operator from the hopeful amateur. The irony is that waiting for confirmation feels harder in the moment, but is easier in the long run. Acting on every breakout gives you a rush of activity, but drains your capital. Waiting feels like inaction, but preserves your capital for the real move. One way destroys you slowly, the other builds you steadily. The market always gives you the choice. Which path you take depends not on the chart, but on your discipline. So, when the price touches the edge of the box and threatens to escape, ask yourself, has it proven its strength, or is it merely testing my impatience? Has volume confirmed? Has context aligned? Has time allowed the move to show itself? If the answer is no, you do nothing. If the answer is yes, then and only then do you act. This habit is not easy. It goes against the impulses of fear and greed. But it is the habit that keeps you alive, and in this business, staying alive is the only way to profit.